I'm Martin Joel from the Basel Practitioners Private Limited. In this video, we're going to cover the high-level overview of Basel III post-crisis reform. The BCBS has published its final Basel III post-crisis reforms on December 7th of 2017. The Basel III framework is a central element of the base committee's response to the global financial crisis and provides a regulatory foundation for a resilient banking system that supports the real economy. The Basel guidelines mainly hovers over this capital adequacy ratio, which is nothing but the Tier 1 plus Tier 2 capital to the IRRBB. The initial phase of the Basel III guidelines addresses the shortcomings of the numerator part of the capital adequacy ratio. The Basel III post-crisis reforms, popularly referred to as the Basel IV guidelines, address the shortcomings of the denominator part of the capital adequacy ratio, with the key objective of ensuring the credibility and compatibility of the IRRBB computations across banks and jurisdictions. In fact, European Banking Authority have conducted studies and proved there's significant variability across banks and jurisdictions. These graphs show the same thing. The BCBS has proposed the Basel III post-crisis reforms with RWA in mind. To achieve this objective, let's see what all the changes that have been brought between Basel III and IV. Firstly, it enhanced the robustness and risk sensitivity of the SCCL approaches. This addresses the variability issues of different approaches. For example, in the case of counterparty credit risk, they introduced a new standardized approach called SACCR, which is more complex and risk-sensitive than the current CEM methodology. This is expected to reduce the RWA variability between the standardized and advanced IMM approach. Second of all, they proposed a lot of constraints on the usage of internal models methods. As per the latest guidelines, advanced approaches can be applied for CVA and equity RWA computation. Similarly, IRRBB approach can't be applied for banks and large corporate exposures. On the top of it, it induced parameter floors for inputs like PD, LGD, etc. Finally, the RWA using the internal models methods is floored by a percentage of RWA as determined through the standardized approach. The capital floor starts with 50% and eventually will become 72.5% based on the new standardized approach. By adopting these key principles, the BCBS aims to achieve the key objective of credibility and compatibility of the RWA computation. Let us now understand the key components of the Basel III post-crisis reforms. This is the new standardized approach for computing the exposure amount for the derivative contracts. These guidelines are mainly to address the credit concentration risk. In the US, the guidelines are known as the SCCL guidelines. You can watch a video we made on this topic by clicking right here. As explained in the previous slide, it is used to address the variability issues of RWA. The SCD approaches risk sensitivity and complexity, which has been improved and brought a lot of constraints in using the IRRBB approach. It is used with the aim to reduce the mechanistic reliance on credit ratings. The existing securitization process has been revamped and introduced a new hierarchy of 3 approaches called SECRBA, IRRBB, and SA. The new approaches mainly rely on the information that is available to the banks and on the type of analysis it can perform on a specific transaction. Introduce caps on RWAs for senior tranches and floors on securitization and re-securitization. Overall, the risk sensitivities of the approach have been enhanced. CVA risk is a form of market risk and is realized through the change in the mark-to-market value of the bank's exposure to derivative counterparties. Hence, the revised CVA framework has been designed and calibrated to be consistent with the FRCV method of market risk. Step-in risk is a new concept where a bank may provide financial support to an entity beyond the contractual obligations. This is not there earlier though. Coming to IRRBB, Interest Rate Risk and Banking Book, and TLAC, Total Loss Absorbing Capacity. MREL is a European version of TLAC, which is nothing but the minimum requirement for own funds and eligible liabilities. The FRDB is a comprehensive suite of capital rules developed by the BCBS as part of Basel III. These guidelines are intended to be applied to banks' wholesale trading activities. Finalized in January of 2016 as the minimum capital requirements for market risk, it aims to address a number of shortcomings in the existing Basel 2.5 framework. A new standardized methodology has been introduced, which is based on the principle that historical loss experience will be regarded as a relevant risk indicator of future operational risk loss exposure. That indicates there is no more AMA approach in the revised guidelines. The BCBS has revised its public disclosure requirements. In other words, the Pillar 3 reporting requirements. In the Basel III world, the regulator issues both principles and prescriptions. These requirements are more complex and comprehensive though. It also requires reconciliation between risks and financial statements. RWA using the internal models methods is floored by a percentage of RWA as determined through the standardized approach. The capital floor starts with 50% and eventually will become 72.5% based on the new standardized approach. Thanks for watching. If you like this video, please like, comment, and share. If you need any clarification, please reach us out through our email. Please subscribe to Basel Practitioners for more videos on Basel IV and FRTB.